welcome. I got Jeff back to the channel. Fortunate enough to do another podcast with us. Thank you for hopping on. This one's going to be a bit different than the other ones. This one I want to do a rapid fire. So I want to get people the most amount of value in the 10 minutes that we could spend together. So let's get straight to it. You ready?
Yep.
All right. Now let's say I have 6 figures and upwards of 7 figures of disposable income. Why on earth would I even consider an algorithmic trading software? It's so new to retail side of things. So how can you debunk this or help give some insights?
Yeah, so I think most people make a major mistake in investing just doing what everyone else is doing. You got to realize when you're playing in the secondary market, meaning you're buying an investment or trading on an exchange or a broker, you are playing against everyone else. This game is a zero-sum game. So if you do exactly what everyone else is doing, there's no way that you're going to get an above average result. And the problem with the average results nowadays is they're not even keeping up with inflation. People think that the CPI number is exactly what they need to be outpacing, when in reality, that's a highly manipulated number. The CPI is, in the last few years has been between 3% and 9%, but that's a basket of goods that's heavily manipulated to fit a narrative. So they include things like museum tickets, funerals, milk, and they don't put proper weights on the important things. Like, for example, my rent in Miami went up 100% in 2 years. Like when I moved there in 2020 to 2022, it went up 100%, which is a very significant portion of everyone's expenses on a monthly basis. I did some calculations and more deep dives, and I've talked about these statistics to a lot of our clients. Just spoke at another event in Miami called the Money Show event. When the people realize this fact that I'm about to mention, it completely shifts the dynamic of how you invest. The M2 money supply in the last 23 years has gone from 4.6 trillion to over 20 trillion. It went up 347.17%. It's gone up 15.09% per year. Or if you were to compound that, it's 6.53% compounded annually. The problem is people are thinking, CPI inflation is only 3%, right? So if they're doing 6%, they're like, okay, I'm still net positive 3%. Yeah. But in reality, if you look at, which I think is the most important, is the debasement of the currency or the amount that we're printing of new currency. That is what you need to determine on how are you actually outperforming that? Because even if the numbers are going up in your brokerage account, you're actually still losing value because everything is denominated in the US dollar. So you're looking at your equity portfolio denominated in the US dollar. You're looking at your house denominated in the US dollar, Bitcoin denominated in the US dollar. So you need to understand, okay, well, if the denominator, aka the US dollar, keeps going down in value because we continuously print more and more, it's all based on supply and demand. When there's too much money chasing too few of goods and services, what's happening is the new money is stealing value from your old money. So it's the silent tax that erodes your wealth. And if you're not outperforming that 6.53% compounded annually, or if you're pulling profit like you're in an annuity or something, you got to be doing over 15% a year to outperform what's happening, which is the debasement of our currency. And it's not going to get better because our debt, we're an obese country because we're at 120% debt to GDP. The reason why that's important is because that's even been growing quicker. I think it's up like almost 400% in the last 23 years. We went from 5.7 trillion in 2000 to 33.17 trillion in 2023, 475%. The reason why the debt is important because what they do is they print more money to devalue the debt to make it cheaper to pay back. And as our spending continues to get worse and worse, and we pay for all these wars and we do all this crazy stuff, we have really no budget. We just continuously spend money. And where does that money come from? Well, it's now coming from us just continuously printing more and more. So the problem is going to keep getting worse. So you have to make different decisions with where you're putting money and how you're investing money. That's why I'm such a huge proponent to alternative investments, because like at the rate that things are heading, you have to have higher performance in your portfolio. And I'm not saying put everything into a trading algorithm or into Bitcoin, but I'm saying that you really need to start thinking about switching the allocation in your portfolio to some extent and starting to be in alternative investments a bit more that can yield a higher rate of return so that you're not losing value. Like if you're in a whole life policy that's earning 4% a year, you're losing value. And people don't understand that concept. And this is somewhat of a new concept, right? Because like we came off the gold standard 50 years ago, but the problem is getting exponentially worse. So that's why I dedicated my career to alternative investments. Like I pretty much only focus on crypto-based investments and FX and commodities, and that's pretty much all I invest in is those three different assets.
So if I heard you right, no decision is still a decision, because even if you just leave your money in traditional, maybe a savings account or CDs, whatever it may be, you're still getting eroded.
Yeah,
from inflation.
People
So-
don't realize that anywhere that you're holding your value, if it's sitting in cash, that's an investment.
Yeah.
But that investment is guaranteed to go down.
Yeah.
So you're guaranteed to lose money.
Guaranteed to lose money.
Guaranteed to lose
So,
value. It's not
value.
money. You got to switch these
Because the number's
dynamics.
going to be the same.
Exactly.
But
the
what it
number's
buys
gonna be
is
the
less.
same. But it's this, again, it's a silent tax that erodes your wealth.
Yeah.
And you don't realize it.
So people are almost forced into a position to become a savvy investor beyond traditional ways, is what it sounds like.
Yeah, you have to. If you don't, you're losing value. You have to. It's a zero-sum game. When we're investing on a brokerage or we're trading on an exchange, we are betting against other people. So you got to realize you have to have some type of edge to outperform the rest of the market. In order to do that, you have to think differently. And that's what our whole brand is about, Nurp. It's a weird word, and it came off of a house that I saw explosive growth in. That's a very oddly shaped house. And I named it that because I saw explosive growth, number one. And number two, we think and act differently because you have to in investments. If you don't and you follow the herd and you're just with your financial advisor that's putting you in the traditional 60% equities, 40% bonds, you're going to just do the best you're going to do is the average. If not, you're probably going to even way underperform the average because like people are getting smarter and smarter, and you need to be leveraging different types of investments to outperform what the market's doing.
I agree with all of that, and I'm in total agreement. Let's pivot from here because you brought up Nurp. I actually want to move the remainder of this segment into the awareness of Nurp. And the way I want to do that is I want to know what are some of the common objections or objections that you've handled in the past with your trading software company, Nurp.
Yeah, I think the biggest thing is just people aren't educated on how it works. I think a lot of people don't realize the difference between investing and trading. And like this is a really key piece to understand was like the seasonality piece. You can get rid of the fluctuations and timing of markets when you start to trade, because what happens is when you trade, you're extracting value from the market. When you invest, you're investing and waiting for that asset to appreciate long term. But in trading, your positions sit in cash. So when the algorithm senses an opportunity, it'll execute on that opportunity and then it goes right back into cash. You don't have to worry about Jerome Powell raising interest rates or the economy going to a recession or the stock market coming down, because the algorithm is betting on both the long and the short side. So betting on price going down or up. And it doesn't matter what the market or the economy is doing, which is so key. If you talk to any investor, if you have uncorrelated returns that are not affected by the traditional markets, that is massively valuable because you understand compound interest.
Yeah.
If you can continuously grow something over long periods of time and grow that growth on top of the previous growth, power of compound interest is insane. When you understand that piece, you know, what's the quote we were just talking about? The eighth wonder of the world. He who learns it, earns it.
Yep.
He who doesn't pays it. And the people that are going to pay the compound interest to people like me are the people that don't understand the inflation metrics that I just talked about and aren't educated to think about alternative investments and how that could fit in their portfolio.
All right, so I'm going to act as a filter here. So basically, the objection here was they're unaware of the ability of the software, how it works, and what it's actually solving for them.
Yeah.
So they'll come in and they're just like, what is this thing, and how is it even working? I'm assuming that's what it sounds
I mean,
like.
they just don't understand trading software. And then the other piece is just obviously our performance is like really high. So people like flat out don't believe that we're doing that type of performance, even though we're showing, like, we'll literally log into the live accounts. We show them the withdrawals that we're taking. We show them third parties that are connecting to the account that shows every single trade.
I mean, I've been documenting
thousands
the
of trades. We've been documenting it from the complete setup of the account, the deposit of the money, the withdrawals that we take. I mean, I don't know how much more we could document, but we are getting, we're going through a third party to audit our statements right now so that we even have another third party to verify that performance. But here's the thing that I think that, because I understand, they look at their portfolio and they're like, wow, I'm doing 8% a year. And how is this account averaging 8% a month? And the thing is this is still a speculative, high risk investment. That's it. And you got to realize that when you have higher percentages, you do typically have higher risk. So I'm not going to say that buying a treasury bond and investing in an algorithm is the same, because it's not the same whatsoever. Obviously, the performance is way different and the risk is way different. So you have to understand risk reward. And if you are shooting for a higher percentage, you're likely taking more risk. But The reason why the accounts can do it is we are using accounts that have a higher degree of leverage. So a lot of our strategies are just looking for very short-term fluctuations in price, and then they capitalize on those really short-term fluctuations in price. We're looking for very small moves in the market, and we're putting a higher degree of leverage in that move. Some of our algorithms will look for like a 0.1 to a 0.5% move. So they'll enter here and they'll wait for a 0.1 or a 0.5% move, and then it'll close that trade.
But with a large amount of leverage.
But with a larger amount of leverage, yeah. So in FX, you can, because the markets typically move very slow, like a 4% move over a week is a big move. But a lot of the brokers will allow you to have a higher degree of leverage, and that's how we're able to get these higher returns, because the accounts are leveraged, and we're also trading 20, some of our strategies are a dozen or over 20 pairs, but 20 different pairs at the same time. So we're looking for all these micro opportunities on 20 different assets at the same time. And a lot of the times it's in many different trades on those 20 different pairs at one time. So it's not like we're just like, oh, we're doing 8% a month and we're buying an investment. Like, no, it's looking for a ton of micro opportunities on dozens and dozens of different assets all at the same time, using a higher degree of leverage. And then if the investor wants to like lower the risk, like they just lower their position sizing. Like some people just they're happy with 2% a month.
Kind of like my account. The
like yours is a little bit lower of a setting. And like it's a black box solution. Like we're all trading the same type of strategy, but the user can adjust little things like their position sizing. And if they don't want to take a lot of risk, like you can set a stop loss for it to close all the trades at a 10% drawdown. So if the market went crazy, your position conservatively, the account balance comes down by 10%, the algorithm will just cut all of the trades to get out of the trades so that you don't lose more than 10%.
Nice.
So it's up to the user.
We only got a few minutes left. There's one objection that I would love for you to answer. I'll give my own narrative on it, but I think it's quite funny and comical because I've gotten it more than once, and I'm pretty sure you've gotten it before. People say, if it's so good, why would you sell it? And let me just give my 2 cents. My 2 cents is, why would anyone make anything to sell it anywhere then? Because everything that goes to market is something that's good, right?
Yeah.
I mean, you just got to be a business person at the end of the day. Why would you want to make 12% by yourself and just make 12% for a long period of time when you can make 12% and also run a business in tandem, making tons of money for tons of other people? I think that's way more exciting. One, and it also expedites quantum leaps in your wealth.
Yeah.
It's quite a logical answer, right?
Yeah, there's many different reasons why, but I would say, like, if you were to use this logic and apply it to anything financial, you would say that no one would ever be in business in a financial business. Why does Ray Dalio run a $100 billion fund when he's already worth tens of billions of dollars himself?
Yeah.
Because he can help more people. He's in a scalable business.
Yeah.
And he wants to make more money for himself and for his investors.
Yeah.
Right? You could say that about anyone. Why is Warren Buffett still working when he's worth $90 billion?
Yeah.
Because he thinks he can probably make more and help more people. It's the same thing. And I've run the math. Like, I think it would be a pretty dark, dull life to just grow your wealth by yourself and not see impact on anyone else. I did, some deep dives on personal development myself, and I took courses from like John DeMartini. One of them was a values determination test, and I found out what my highest values were. So like I wanted to have freedom, options, and choices. I wanted to see impact on people, and I wanted to have uncapped earning potential. I wasn't having any of those three in the corporate world when I was at the biggest bank in the United States. So I'm like, I got to design a life that's going to fulfill those three things, because that's what, at the end of the day, makes me happy. Can't tell you why, but that's how I function. Designing businesses around my values are exactly what makes me purpose-driven and focus more. Like I said, I've done the math. I don't have $100 million cash that I can go put into an algorithm right now. Like I'm not that liquid. I'm not that wealthy right now. But what I did do is I ran the math on like, okay, let's say I have $5 or $10 million in cash and I want to put that into the algorithm, and I can compound at, let's say, 6 or 8% a month for the next 10 years. I've done the math on if I'd go that route and run that model. Or what if I run that model to an extent, but let's say I don't put as much money into it, and then I also build a business around these different trading strategies. The amount of enterprise value that I can build through a recurring business that's in SaaS, aka software as a service, we can get multiples anywhere between 9x in today's market. And I've talked to a lot of investment banks, the biggest investment banks in the world I've talked to over the last 9 months. And they said, today's market, 9x on recurring based on where you guys are currently at. In a good market, it can be as high as 30x. So you can get paid 9x of your revenue. Okay, this is not EBITDA. This is of your top line revenue if it's recurring, or up to 30x, which means that you're getting anywhere between 9 times your annual recurring revenue or 30 times your annual recurring revenue in 1 year. So you can make 30 years of income in 1 year from running a software as a service business that has a recurring revenue model. So I can actually, instead of going the Jim Simons route, compounding for 30 years to, generate the whatever $100 billion in profit that they've done, I can do that in a different way, building enterprise value through a business. And I can also run my own accounts. And that's why we're specifically focused, a large portion of the strategies are in FX because it's a $6 trillion a day market. So there's deep liquidity, and we have a very scalable model because we can continuously invest ourselves, and so can the other users, and it's likely not going to impact ours. When it does, because at some point it can impact, because obviously nothing is infinitely scalable into infinity, we would pause any new clients coming into that system, and what we would do is we would make slight adjustments to the periods, to the time frames, to the actual indicators that we're using. We can formulate the overall same core strategy, but make slight adjustments for it to perform and enter and exit at different levels. And then once again, we've got more scale once we move to that model. So I could go on this all day, but I hope that makes sense.
No, that makes complete sense. And I'll reiterate it to them. So solution 1, a decade you become worth, let's say, 100 million. A decade. Solution 2, you become worth 100 million in a few years. Which one sounds better to you? Plus, the second option makes a lot of other people wealthy alongside you.
We're seeing crazy impact.
I'm pretty sure anyone with a logical brain would understand what option to take here. And if you did go with option 1, where the software is just for yourself, I would actually consider you probably quite selfish. With that being said, I think that's all we got for you today. Thank you for hopping on here, Jeff. We're on a tight crunch, so I know we got to roll. You probably have a meeting in right now.
He was just calling me. Yeah.
You might as well take the meeting on the podcast to let these people know that you're actually really working on the business. So go ahead and take the meeting, and we're signing off here, guys. Peace.
See ya.